Welcome to the Aquest Podcast, conversations about regs, funds, and governance with your host, Daniel Lawler.
Hello and welcome to the July episode of the Aquest Podcast, the easy listening funds industry podcast. My name is Daniel Lawler and I'm the host of this podcast. For this edition, we are going to move a little bit outside the funds industry and see what we can learn about risk management from the guys who are probably the best at that task, and they're the bookies. So for this episode, I'm delighted to be joined by my co-host, David Lyons of Swan Sports. Thanks very much for joining us, David.
My pleasure to be here.
Tell us a little bit about yourself and about what it is that Swan Sports does.
Well, a little bit about myself, I suppose. I've worked in the gambling sector for the last decade, primarily with Paddy Power. Worked in their online gaming business originally, bingo, casino, poker. And then following that moved into a section called Art and Risk Management, which is a division of the company which helps corporate clients manage the financial risk related to the outcome of sporting events. Since that, over the last couple of years, 2 years ago, I've left Paddy Power, and over the last year, Swan Sports Limited is up and running with my business partner, who was also a director of the business-to-business operation in Paddy Power, Rod O'Callaghan. So we're doing the exact same thing as before. We help corporate clients manage their financial risk related to the outcome of sporting events. Now, what does that mean? Player bonuses, sponsorship bonuses have become far more prevalent in the sports sector over the last few years because brands just don't want to throw money at a team anymore and just say, we would like to be on the front of your shirt for €5 million. That just doesn't exist. What they will say now is, we'll give you 1 million to be on the front of your shirt, but we'll give you another 5 if you win the Champions League, another 5 if you win the Premier League.
So is there much more weighted towards the bonus side of things now?
Absolutely, because you get more bang for your buck related to positive performance. So a team a sponsor will see huge more eyeballs on their jersey if the team progresses through the Champions League or is getting more airtime on Sky Sports. The same goes for a golfer in the Open, which has been played today. If one of Jordan Spieth's sponsors, Puma, for example, they will have bonuses tied to his performance, and if he wins the Open today, he'll receive a bonus off the back of that. Now, that creates volatility on the P&L for the brand themselves, so they're related to a massive spike or nothing at all in terms of payments. So what they can do is they mitigate that risk by either taking out an insurance policy, placing a bet, or placing a hedge, which allows them to manage their risk in advance. So regardless of what happens on the course, whether Jordan wins or not, they have a known cost on their P&L, essentially an insurance premium. So
it helps them to manage the risk. And I suppose, you talked about the way that sponsors, that model has gone very much towards, a large portion of it being based on bonus. Is it the same with the actual players and how teams contract with their players?
Yeah, it's a little bit different with the players. Players certainly expect goal bonuses, appearance bonuses and so on. But they get so much money. Football becomes a little bit of a misnomer in terms of the bonuses are inconsequential, whereas something like the Rugby World Cup would be far more relevant, where the players aren't on as an enormous a salary as a footballer. So a bonus payable to the Irish players from the IRFU or from a shirt sponsor or from a kit manufacturer would hold far more sway. And also those bonuses payable by the IRFU, for example, would have far more effect on their annual results.
And so if you're a team or a sponsor, a brand that's trying to manage the risk, then how did they go about doing that? Obviously, there's different options. How do they
There's different
decide
options. So the premium is directly related to the probability of the event occurring. So hedging Manchester City to win the Premier League next season is going to be a very expensive proposition because it's so likely to happen. Whereas hedging Leicester City to win the Premier League a couple of years ago would have been very, very cheap. So it directly relates to the probability of it happening. So, for example, let's take Manchester United, for example. If they were 9-1 to win the Premier League next year, that represents a 10% chance. And for the ease of mathematics, if they had a 10 million bonus payable to the players, they could hedge that bonus for €1 million. So they give us the €1 million, and in the event Man United win the league, we pay the 10 million. But if they don't, we keep the 1 million premium. Very much like insuring your car, which is again a probability-based scenario, which is run through models. Whereas this is probably a little bit more granular because they're individual outcomes. They're very bespoke events, but the same principles apply.
And so when you're the other side of that trade, obviously, you're the one who's helping them to manage the risk.
Yeah.
When you take that risk on, how do you go about managing that risk? What are the factors you take into account? Is it very model based and very formulaic, or is there more of a value judgment as well?
More from the betting sector, when you're taking on large volume of trades on winning the Premier League, the price, although while it needs to be solid, the market will dictate whether your price is wrong, and the weight of money will prove that to you. So you'll be taking people start piling into Manchester City to win the league at 10 to 11. You know that your price is probably going to have to shorten. Whereas with us, we have to look at each risk on its merits. So even though the market would dictate that a price for Man City to win the league is 10 to 11, we would then need to look at that in greater detail, because obviously the risk is far, far greater. Your payout would be more than maybe the rest of the book combined. So you have to look at each risk individually. And
when you're doing that, then obviously probably the depth of the market, is that something that comes into it? You know, the amount of, in financial services we talk probably liquidity in the market, the amount of trading, you know, that give you a better price for
Yeah, it does. And in an ideal scenario, you'd be able to log onto a betting exchange like Betfair that's got an enormous liquidity behind it, but in that individual market, and it'll pretty much tell you to a T where the price should be. But that's not always going to be the case, because a lot of this stuff is done anti-post, and the betting markets mightn't have developed sufficiently to give you an accurate representation of the price. Like if we, again, using the Open example now, if we were to log on to any of the betting exchanges and see where the prices are for the Open, they're going to be pretty solid, and there's going to be a good bit of money behind them. So it becomes very easy to lay a golfer now. But to do that 6 months ago, when a sponsor is looking to manage their yearly budgets, you don't have the luxury of that type of information to hand. So you need very skilled golf traders who are not only mathematically sound, but also have a very detailed knowledge of their sport. And you might take a panel of prices and then take an aggregate price across your traders to help to give you your end price, and then you obviously marginate that price accordingly.
So you're relying a lot on their expertise and their knowledge of the market. And is it their knowledge? Is there more sort of qualitative factors that come into it then as well? Like, I don't know, form or injury or...
Absolutely. And in terms of all of those things, absolutely will play a factor, and right through to momentum. So they would even build momentum into their pricing, so that you know that if Rory McIlroy has won 2, 3, 4, 5 tournaments over the course of a 6-month period, he becomes far more likely to win subsequent tournaments over the year, because form and momentum are dictating are affecting his probabilities now. So absolutely, they would take all those into account.
And so after you've done the deal, done the trade 5 months out from an event, your client has secured their position and they've paid whatever they're going to pay. But obviously on your side then you've got an ongoing risk.
We have an ongoing risk.
So you're monitoring what your return versus what your risk is now, and whether that's gone up or down. Is that how it works?
Absolutely. You're probably marking to market your risks very right on a monthly basis anyway, to see where you stand versus the price you laid it at. The main time to worry in any gambling product or a gaming product or insurance product, the time to worry about your data and your prices at the very start before you've done the deal. So once you're locked in, generally anyone involved in the sector doesn't like to hedge at a loss. So ideally, if you're trying to transfer any risk, you try and do that at a profit. But for the most part, anyone in the sector is competent and will retain the risk themselves.
And so it's a very professional sector. It's a very well developed sector. Is it very broad in the sense that are there certain events and certain sports that are covered, and then others, as you move into the margins, are maybe there's less knowledge about them and more risk?
That's probably a really good point. So there are sports that we're really comfortable with pricing: rugby, football, cricket, golf, tennis. American sports, baseball, for example, is very data heavy. There are very few unknowns. Something that might be trickier would be something like Formula One, for example. Formula One, like let's take McLaren, for example. McLaren probably not only how quick their car is going to be for next year, they probably know how quick it's going to be for the year after. So if a Formula One team was to come and look to hedge driver bonuses with us for next season or season after, we would be a little bit hesitant, because they know more about their car than we do. That's only natural. So generally for something like that, we wouldn't underwrite any Formula One related risk till after the final round of testing is completed in Barcelona in May. You get a good idea of where you're at then. And then I suppose lower league football, where maybe you might run into some more morally hazardous behaviour, where you, in certain leagues throughout the world, somebody might be able to make more money from their team not performing well than performing well. True. So yeah, you really
insider
have to,
dealing and that kind of stuff. If you're in a financial,
that sort of stuff, you've really got to be careful. And if you're going to lay a chunk of change on the table for that, you really need to know what you're doing. But we try and steer as well clear as that as possible. But obviously, in the likes of the UK, Spain, the secondary leagues, third divisions, are fine. Everyone's trying to win.
So when you get towards the margins, it's things like you're worried about your level of knowledge versus the person who's making the trades level of knowledge, and do they know something that you don't know? And then because the markets aren't as deep, you don't have the other sources of information to sort of test your pricing against.
That's exactly right. Whereas we would ideally love to underwrite maths-based games all every day of the week. So, like, I don't know, roll a dice, roll a 6 to win 100 grand. We know for sure what that price is, and but I suppose that's an ideal world, and we don't live in an ideal world. So if we try and stick to the sports we know most about, and we're confident in our pricing and we're confident in our methodologies, then we should be okay.
And so presumably you build models around this, and you have models and you're probably refining them as you go?
Yeah, in our sector we wouldn't build models. Previously, in a previous life in Paddy Power, we definitely would have operated off models, and a lot of the models, for example, every single bookie out there would have had a World Cup model which was spouting out prices for every single eventuality you can imagine, in terms of top goal scorer, reach the final, reach the semi-final, win the group, not win the group, and that'd be highly model driven.
And so what kind of factors do they put into those models?
It'd be form, squad, injuries.
And do they rate them? Like, is there a value judge? Is somebody behind that who's using their expertise to put a subjective view on what form is?
Absolutely. In every sport and all the models, at some point somebody has to key in an individual match price, which is probably where the whole system is built upon. So somebody has to know the probability on game one of, who was game one of Russia beating Saudi Arabia, maybe.
Yeah.
So at that, but in order for the model to work, the match prices have to be inputted at the very start.
So there is always a reliance on individuals and on the human being.
Absolutely. Like, really interestingly, in Paddy Power, when we football models are constantly being developed, and they're absolutely necessary, because it means that a betting and running trader can trade on several games, whereas historically he could have traded on one with fewer markets because he was doing the calculation himself. The football models now calculate, I think, just over, during any game, about 1 million prices per second. But there still has to be a trader there to manage the stuff that the model can't see, that Luis Suarez is injured, that the goalkeeper is not taking crosses cleanly. So there has to be sort of manual inputs. And interestingly, over the course, if you put a trader head to head with the model, well, historically, it may have changed now since I've left, but we never had a model that could beat a trader in an individual match in terms of margins.
So the traders as individuals must be very highly sought after.
They are extremely highly sought after. Now, the traders are there's sort of two guys. You probably have more the quants guys who build the models, and then the traders who operate them. All mathematically sound. The quants guys, extremely mathematically sound. But the guys who are trading on the sport will also be an expert in that sport. So you need these guys in there as experts to prevent, I suppose, for want of a better term, having your pants taken down by a customer who's looking to exploit the fact that your prices are wrong. So
presumably these star traders, they're the guys that are in demand, and they probably have their performance probably has a big impact on the P&L of the organisation they're working for.
Absolutely, and they're very highly bonused, and they do very well, and they're also, sometimes, not many that I can recall, but they're also found out quite quickly if they don't actually know what they're talking about, because someone will go out there and exploit a price that's wrong, or they will exploit a weakness somewhere in the market and have a good bet, and
And do you find a lot of high frequency betting then? People who are constantly monitoring prices and trying to arbitrage the differences in prices. Is that professional?
It is. That was supposed to be professional gambling. Arbitrage would be a little bit. It's there's only so much you can make from arbitrage. But guys who are the most dangerous and the best punters are the guys who come in and bet early. So when, let's say, a rugby handicap is released on a Monday for the following Saturday's game, that is, on the Monday when that price is released, that's when that price is most vulnerable. That's when it has its highest chance of being wrong. And that's when the shrewd guys who will also have done their pricing at the back end will be trying to place bets. And very quickly, the market will adjust that handicap price to where the guys who are placing the early bets on. So there's enormous value on these guys. They will also, some bookies will allow those accounts to stay open and allow them to place small bets, because basically buying the information, they want to see what this guy thinks or what this girl thinks about an individual result. But generally the market has moved towards closing a lot of these guys down, which, I don't know. I'm out of the gambling sector a little while now, and I would fancy my own little knowledge on rugby, but I'd still like to be able to get more bets away. Put it that way.
And so for the traders then, do firms place limits around how they do their job to manage the risk?
Yeah, they would have risk limits, and there would be bet referrals if it was an exceptionally large stake, or if it was a customer who had been stake factored and wanted to have a certain amount on. But they would be working to predetermine parameters, but they would also be able to use judgment and trade as they see fit. So
there's a lot of commonalities there with how in the financial services industry firms manage risk, their need for raw data, their need for liquid markets where they can sort of see what prices are and test what prices are, but ultimately the need for good traders who know what they're about and who just have that sense for where things are going to go, maybe beyond what a model can tell you. Absolutely. And I suppose when a trader has just started a role, his parameters would be more confined than somebody who has proved themselves over a period of time that they can actually deliver. So yeah. And talk to me just a little bit about technology and how technology has impacted the betting sector more generally. So obviously a lot of betting companies are very, very savvy about how they deal with their end users through technology, and I think it's a sector where the financial service industry is definitely playing catch up, albeit banks are a little bit ahead of that. But if you in terms of trading or trading stocks, shares or funds, you don't have that same ease of access that you do with say bookmakers. And I think that the use of technology probably applies to both sides of the coin. So in terms of how a customer actually interacts with a betting site via an app or via a website is a very, very smooth process. There's a huge emphasis placed on ease of transaction and ease of navigability of the site, and where people's eyeballs are dragged to on sites at different times of the day, and where should your offers be, and so on. And they're definitely like leaders in terms of that. Because it's not a new industry, It's not a new industry, the bookmaking industry, but they do seem to have identified that as a win and have put resources into to be good at interfacing with customers through tech. Much earlier than absolutely. Well, several, probably like 5 years. I'm getting ballpark, but about 5 years ago, just over. Paddy Power were the first ones to have a mobile app and the first one to have a tablet app. And very quickly, about 5 years ago, over half of the company's turnover was online, and just over half of that online turnover again was on mobile. So it's grown exponentially. It's been an incredible growth sector, and I think that comes from because it's so easy to use. People use their phone as a market reference point. You're in the pub having a pint with your friends. I wonder what price Wayne Rooney has to score the next goal, and you have the information there at your fingertips immediately. And that from the back end, from the side we've just spoken about about traders and the quants, that the price is going to be pretty accurate. So it gives you an accurate data point and a discussion point to use in a social environment. Yeah, and I guess the experience that firm has had is probably replicated across all of the big firms. Absolutely. In the industry. So some were slower to adapt. Obviously, I think Ivan Yates famously said that saying that online betting will never take off. Right. That's the disc jockey.
Yeah.
Okay, that's great. Well, thanks very much for your time, David. That was really, really interesting to see how another sector tackles the issues around risk management, and it's just interesting to get insights from other sectors doing the same kind of thing that the fund management companies have to do. So thanks very much.
My pleasure. Thank you.
So as we wrap up this episode of the Aquest Podcast, let me again express my thanks to David Lyons of Black Swan Sports for his time and insights into the area of risk management. Let me also thank Gavin Timlin of Create Sound for editing and recording this podcast. We're probably going to take a break for the rest of the summer, and we will be back in September with the next episode of the Aquest Podcast. Thank you very much for listening, and if you have any feedback, I always love to get it at info@aquest.ie. Thanks for listening.
You've been listening to the Aquest Podcast. For information about our training and advisory programs or our academy, visit aquest.ie. For more resources on regs, funds, and governance, check out our YouTube channel, Daniel Lawler, RU, RQ.